investors are thinking that once we start getting remobilized, all of that technology, we still need it. We don't want to dump it. We're going to continue to embrace it, but not just as much as we needed to in the last year when we were all in shutdown mode. And so I think that what you're seeing is a recalibration, a reassessment of what's the forward-looking growth opportunities and expectations of where investors can expect reasonable growth and a reasonable return on their investment. And so we are really trying to make sure that we stay focused on where the markets are moving and where we see opportunities to invest. And we're trying to not have inflation fatuation. The inflation, we're concerned, big move today, but we don't see that as a long-term challenge, especially when we look at it at an absolute level of the 10-year Treasury being right back to where it was going into the pandemic a year ago.
Yeah, you know, Dan, I know there's a lot of people out there that are probably frustrated by this move, but most of those people, if they've been holders for more than, a cup of coffee, have made a lot of money. They've made a lot of money on this trade over the last couple of years. I can't blame anybody for saying, okay, you know what? We rode the apple cart for 10 years. Let's take the profit, put it in something that we view as undervalued. I know you've got some picks, Bristol Myers and others. There are other, maybe better ways to make money than Apple and technology right now, are there not?
Well, Brian, I think you're right. And I think what people are seeing is that the whole technology sector right now, if you look at the S&P, it's trading at about a 26 multiple. The market itself is at 22. So that's a pretty significant premium. And so in line with what we're discussing, I think people are just taking some chips off the table. They're beginning to see that clearly we're going to have a significant reopening trade. I mean, we're likely to be at a close to a 5% GDP run rate as we move into the third quarter of this year. So certainly looking at the companies, the energy companies obviously are leading the way this year. Those are even getting a little bit toppy, up 30%, but there's still some good healthcare companies. There's some great financial companies that are going to benefit from higher rates as their net interest margins get better. And even in the technology space, I mean, you have a Cisco that didn't participate last year, and it's trading at half the market multiple for the sector. So there's clearly some good things out there, and most of those issues are paying over 3% in dividends. Hold you out while you wait.
Shepard Smith here. Thanks for watching CNBC on YouTube.